This is the kind of story that doesn't make headlines until it's way too late. Because by the time the markets finally react, the real move has already happened. China just revealed something that is quietly rewriting the entire silver market. A hidden $102 billion gap that most people never even knew existed. And the reason this matters so much isn't about silver itself. It's about who's exposed on the other side of that gap. For years, silver was treated like an afterthought. Gold got all the headlines, crypto got the hype, stocks got the trading volume. Silver just stayed buried in the background, quietly dismissed as too small to matter. But that entire assumption is now collapsing right before our eyes. China didn't announce this with a big press conference. There was no emergency broadcast or official warning. Instead, the signal appeared where almost no one was looking, buried deep in trade, settlement data, industrial demand reports, and delivery discrepancies that simply don't line up with global inventories. When analysts finally connected the dots, the number that emerged shocked even seasoned metals traders. A $102 billion silver gap. We're not talking about missing money here. We're talking about missing metal. So what does that actually mean? On paper, the global silver market looks balanced. Futures contracts show plenty of availability. ETFs claim their silver is backed 1-to-1. Banks report their exposure as hedged and under control. But China A's latest disclosures paint a very different picture. Physical silver demand that massively exceeds what the market can realistically deliver at today's prices. And this is where the real problem begins. Because silver is not just a monetary metal like gold, it's industrial. It gets consumed. Once it's used in a product, it's essentially gone forever. Think about it. Solar panels, electric vehicles, military electronics, data centers, medical equipment, all of these industries consume vast amounts of silver that doesn't come back into circulation easily. China understands this better than anyone, because China absolutely dominates global manufacturing. While Western banks were busy trading silver as a paper instrument, a financial derivative, China was treating it as a strategic physical resource. Over the past few years, China has been quietly increasing its silver imports, locking in long-term supply agreements and building up its domestic stockpiles. But the real, undeniable shift came when their settlement data started showing something unusual. Contracts were being settled off-market. Delivery timelines were stretching out longer and longer. Physical premiums, the extra cost to get actual physical silver in your hand, began to diverge wildly from the paper prices you see on your screen. That divergence is the gap. On one side, you have paper silver, futures contracts, derivatives, and promises of delivery. On the other side, you have physical silver, actual bars, ingots, and industrial-grade supply. The problem is that the paper market is many, many times larger than the physical market, and China just exposed how fragile that imbalance really is. That $102 billion represents the estimated value of silver exposure that simply cannot be physically delivered if everyone demanded it at once. That massive exposure sits primarily with U.S. and Western financial institutions, banks that built their entire risk models on the assumption that silver would never be called for delivery at a massive scale. But China doesn't play by those assumptions. Instead of forcing a dramatic overnight squeeze that would crash the system, China is applying pressure slowly, incrementally, strategically. Each additional ton of silver they absorb tightens the system just a little bit more. Each long-term contract they sign removes flexibility from the market. And every ounce that disappears into industrial use is one less ounce available to settle all those paper claims. U.S. banks are now caught in a position they never planned for. Their exposure was designed to handle price volatility, not physical scarcity. They expected price swings, not delivery risk. They built complex models assuming liquidity would always be there. But liquidity is just an illusion when the underlying asset simply isn't there to back it up. This explains why silver prices have been behaving so strangely. You see these sudden, explosive spikes followed by sharp, brutal pullbacks, violent moves that seem completely disconnected from the daily headlines. It's not randomness, it's stress. It's the sound of a system straining under pressure it can no longer absorb. And here's the most critical part. This isn't happening in a vacuum. China's silver strategy aligns perfectly with its broader resource accumulation plan. We've seen them do this with rare earth metals, with copper, with lithium, and with other key energy metals. Silver fits perfectly into their long-term pattern of securing physical, tangible inputs, while the West is content trading paper abstractions. The U.S. banking system, meanwhile, is deeply embedded in derivatives. Silver is used as collateral. It's used in complex leverage structures. It's used to balance books in ways that assume complete stability in the market. A disruption in silver delivery doesn't just affect one small market. It sends shockwaves rippling outward. If silver prices rise sharply, banks face immediate margin pressure. If delivery is demanded at scale, they face catastrophic exposure. And if confidence in the paper market breaks, they face systemic risk. And China knows this. That's why this move wasn't loud. It wasn't sudden, it was precise. It's the kind of move that doesn't trigger panic immediately, but it ensures that when the panic finally does come, there's no easy exit. Most people haven't noticed any of this. Silver doesn't trend on social media. It doesn't dominate the cable news cycle. But you can be sure that the major institutions whose survival depends on it are watching very, very closely now. Because once a gap this big is acknowledged, it can't be unseen. And the question is no longer whether this $102 billion exposure exists. The only question now is when it will finally matter to everyone else. The most dangerous part of a financial imbalance isn't when it's hidden. It's when everyone knows it's there, but nobody wants to be the first to react. That's exactly where the global silver market is right now. Think about it, like a game of musical chairs, but with billions of dollars on the line. Once this $102 billion gap became visible, a quiet shift began. It wasn't happening in public headlines, but behind closed doors. Major institutions started adjusting their positions, digging into the fine print of delivery clauses, and re-examining the language of their contracts. Why all the secrecy? Because in a market this tight, the first institution to demand actual physical delivery of their silver forces everyone else's hand. It's a high-stakes call that reveals who can actually produce the metal and who can't. And the uncomfortable truth is, most can't. The entire global silver market runs on a delicate foundation of confidence. As long as all the players believe the contracts can eventually be settled with real silver, the system holds together. But here's the crucial difference. Silver isn't like regular currency. You can't just print more of it. You can't conjure it into existence with a new government policy. The supply from mining is limited, it's a slow process, and it's getting more expensive every year. This is a reality that China understands better than almost any other nation on Earth. Their industrial planning doesn't operate on a quarterly basis like in the West. They think in decades. For them, securing silver right now is not about today's market price. It's about securing tomorrow's leverage on the world stage. This brings us to an uncomfortable reality for U.S. banks. Their massive exposure to the silver market was never designed to be stress-tested by a real physical shortage. Their strategies were optimized for things like yield, arbitrage, and keeping money moving. It was a system built for a world of abundance. But what happens when physical demand, driven by industrial needs in sectors like solar and EVs, starts rising much faster than supply can keep up? The paper structures, the contracts, the derivatives, they all begin to strain. And when those structures strain, trust begins to erode. And when trust erodes, markets don't just correct, they move violently. The reason this whole situation matters far beyond the world of silver is because silver sits at a critical crossroads. It touches nearly every major sector of the modern economy: energy, technology, defense, and finance. A disruption in the silver market doesn't stay contained. It spills over, creating a ripple effect. It raises questions about the credibility of pricing in other commodities, the stability of derivatives, and even the trustworthiness of currencies. If silver prices were to spike uncontrollably, it would send a powerful signal that the paper markets, which are supposed to represent the physical asset, can no longer be trusted. On the other hand, if prices are artificially suppressed to prevent chaos, it signals heavy-handed intervention. Either outcome shatters market confidence. Interestingly, China doesn't need silver prices to explode overnight. In fact, a slow, controlled pressure cooker benefits them far more. It allows them to continue accumulating physical silver at relatively stable prices, while others underestimate the growing risk. But at a certain point, pressure builds into a rupture. When that happens, U.S. banks will find themselves staring at three very bad options. First, they could settle their contracts in cash, paying out at ever-rising prices, which publicly exposes the very gap they tried to hide. Second, they could try to roll their contracts forward indefinitely, basically kicking the can down the road while increasing their leverage and risk. Or third, they could enter the physical market and try to buy up the supply they need, competing with everyone else and driving prices even higher, tightening the supply squeeze even further. None of these options are painless. And here's the critical detail most people miss. A silver shortage doesn't announce itself with empty shelves at your local coin dealer. It reveals itself much more subtly. You start seeing delivery delays, rising premiums over the spot price, and quiet changes to the rules of exchange. By the time the general public notices there's a problem, the big institutional players have already made their moves, or they've already failed. This is precisely why China's strategic accumulation matters so much. Their move wasn't a direct attack on the U.S. financial system. It was about positioning. It was about making sure that when the stress finally arrives, China is the one holding the indispensable asset that everyone else desperately needs. History is filled with examples of this exact pattern. Nations that control strategic resources don't need to fire a single shot to exert their power. They simply wait. They let systems built on excessive leverage and paper promises overextend themselves until they break. Silver is just one thread in a much larger, more complex global fabric. But it's an incredibly revealing one. It exposes just how dependent modern finance has become on assumptions that only hold true in times of abundance. Scarcity changes everything. It changes behavior, it changes priorities, and it changes power dynamics. And that $102 billion gap is the very definition of scarcity. The market can ignore it for a while longer. Analysts can debate its significance. The media can downplay the risk, but the math doesn't lie. $102 billion worth of exposure cannot be wished away. It has to be resolved, one way or another, and when it is, the resolution won't be gentle. The real question isn't whether the silver market will move. The real question is whether institutions are prepared for how breathtakingly fast confidence can disappear once the illusion of availability is shattered. China is prepared. The U.S. banking system is exposed. And the market is standing on a fault line that has started to tremble but hasn't fully shifted yet. Because when it does, this won't be remembered as just a story about silver. It will be remembered as the moment a hidden gap in the global financial system finally became too big and too dangerous to ignore.